Well, hello, this is Dean Tinney. I'm coming to you from my studio here in fabulous Las Vegas. We're working our way through an explication of NASAA's test specifications. I highly recommend you print the PDF and you can follow along, take your own notes, do what what you need to do in terms of using this as an intellectual inventory. You're going to get about 6 or 7 questions from this area, which is, as NASA exams goes, lots, because lots of them are onesies and twosies. Financial goals and objectives. So, financial goals are pretty straight, a part of our practice, right? I'm going to ask, what are your financial goals? And well, what are some common ones? Common ones might be college education, for example. Let me get my different color here. Another one might be maybe retirement would be another one, or maybe buying a house would be one. Whatever the case may be, right? And all of these financial goals come with time horizons. What is the, how long before we have to have the money to pay for this college educations? It might be plural, who knows, right? And, what are the arrows we have in our quiver, so to speak, in terms of college education? We have, perhaps zero coupon bonds, or what are the things that we could be using? Maybe it would be a Coverdale, or maybe a 529, whatever the case may be. Retirement would have a time horizon. How long till they retire? Depending on where they're at in their life stage, right? It could be 10, 20 years from now, 30 years from now. It could be, 5 years from now, 10 years from now. And in terms of that retirement, they're going to need an income stream. And so we're probably going to want to know, what income streams are they relying upon? Are they relying upon one of the income streams providing for their retirement to be Social Security? Do they have a pension plan, perhaps, from work? Do they have a defined benefit or defined contribution plan? Defined benefit would be helpful because, right, if it's a defined benefit, that means it's an income stream they can rely upon because their employer is assuming the investment risk. Where if it's a defined contribution, maybe we're going to have to, make some asset allocation choices as they get closer to retirement, or they roll that over, whatever they may choose to do. Maybe they want to buy a house. Again, what is their plan, for time horizon buying the house? They could be, maybe they want to start a business. I mean, you could go through, think of a lot of these, and most firms provide you with kind of a standard, kind of common things that people could do. Now, the investment objective, I used to, when I was a practitioner, say, I'd like to read you a list of investment objectives. I'd like you to rate them on a scale of 1 to 10, 10 being very important, growth, 10, income, 3, tax safety of principle, 10, whatever the case may be. Now, for our purposes, primarily, we're going to have 2 investment objectives provided by the various investment vehicles we have, and that would be growth and or income. If an investment does not pay any income stream, it has no income stream, well, then the only way we're going to make money is through price appreciation. I mean, the idea is we're going to turn the money into investments and the various types of investments found on your exam. And then at some point, we're going to turn the investment back into money. The investment doesn't have any kind of an income stream. Well, then it's going to be, dependent completely on growth. Those 2 things together from other discussions, or total return. And, we're probably going to have some kind of asset allocation model based on growth and income in terms of your portfolio. And what would go into whatever we decide the growth component is going to be, what kind of investments go in there, common stocks, that kind of thing. And in terms of asset allocation, if it's the income component, what kind of bonds are going to go into that part of your portfolio? Your current and future financial situation. Again, pretty important here, pretty important. So, maybe I say, hey, listen, we need to figure out where you're at right now before we figure out where we're going. And so if I said before, your balance sheet is testable on 2 levels. It's testable not only on, the corporate level, but also on the investment level. And so I said, what I'd like to do is take a picture in time as of today. What is your net worth? I'd like to create for you a personal balance sheet. Companies do this every quarter, and I'm hoping as part of our relationship, we'll keep revisiting this, and hopefully, as a part of our relationship together, we'll make that number grow, hopefully. Man, Dean's having our troubles here. Good news, now spelling test. I say, hey, listen, can you tell me about your current assets? Your current assets. We'll work on your personal balance sheet here. That's things are cash or things you plan to turn to cash within the next 12 months. Work on this balance sheet now. As your investment professional, we ought to consider what we need in current assets. Cash are things that we plan to turn to cash in 12 months because, we might want to establish a rainy day fund. Not a test term, it's just, something as we refer to it. The amount of liquidity you need. A lot of practitioners say that, we should have 3 months or 6 months worth of our bills in liquid form. So if something happens, there is a rainy day, we're prepared. And again, this would be based on every customer's, risk tolerance. Me, as I've got older, I like having a bigger rainy day fund. So I like to have 12 months worth of my expenses in current assets. That might be stuff we use as a money market fund. We may use for that. That's where we have a money market fund, high quality debt, maturing in less than 12 months, like bankers' acceptances and commercial paper and negotiable jumbo CDs and T-bills. That would be found in a money market fund, And that's the equivalent of, cash in terms of how we're going to use it in our practice. This is, ready money. Ready money is a man's best friend, they say. So can you tell me about your long-term assets? This would be your house, your retirement plan, things like that. And again, here, I would probably want to know, are we planning on, for example, the house, the asset, is that asset going to be something we're going to turn back into cash at some point? Is that part of our retirement plan that we're going to sell this house once the kids are, grown and graduate college and downsize and take that money and redeploy those assets? We're also not only looking for future redeployment of these long-term assets, but even maybe current redeployment of these assets. What I mean by that is, if you tell me you have a retirement plan, it's a defined contribution plan. Maybe I ask about what your asset allocation model is for that. And then we're going to go over your current liabilities. Things you need to pay within the next 12 months. And, if we are doing this, again, we're looking for opportunities here. For example, maybe you have some credit card debt, and I'm looking at that credit card debt, and I say, you realize that you're paying more in interest on the credit card debt than you're making on the other side, on the investment side. And, maybe we're looking for an opportunity to maybe pay off some of this debt. Maybe that's an opportunity we don't have right now, but maybe it's an opportunity that we can look forward to in the future, right? So we have current liabilities. We also have long-term liabilities. That might be the mortgage. That might be the car payment. Now, one thing they like to do on the test, and then, if we take all the assets minus all the liabilities, we're going to end up with net worth. And one of the things they love on the test is the accept format. So we're talking not about the statement of cash flow right now. We're talking about the balance sheet. And so you need to recognize things that wouldn't be on the balance sheet. All the following are on the customer's balance sheet, except, salary wouldn't be on there, right? There's certain things that aren't on the balance sheet. So they love that accept format. We're also going to be interested in cash flow. Let's just balance this out here. And cash flow is the money coming in and out. Again, like a corporation, we're looking at, the money you're receiving. Now, I realize you're not taking all that money home, right? Because you have backup withholding. So, we're now looking at like salary would be a part of the income statement, as I mentioned, a cash flow statement here. The statement of cash flow is the money that's flowing through. And again, we're looking for opportunities here on this flow through. The top line being, revenue, and then cash flow would include, this the actual money that's coming into your possession. But, no test issue there. But what I'm saying in terms of that cash flow, we're looking for opportunities again to redeploy. Maybe we find some money for dollar cost averaging or periodic investment, whatever that money is. So, we're hoping that there's going to be a bottom line, some positive cash flow here, hopefully. And again, if there's positive cash flow, maybe we can use that to, start investing in a mutual fund, or if we haven't maxed out the 401k at work, maybe we can do that. So, that would be something we'd be looking for. If it's negative, when we're we're starting in a hole, right? And then again, it would be the except format, something that is an item of cash flow, like a monthly expenses, whatever your expenses are, what is that money going out? All right. So we also would want to know about your existing investments. Can you tell me about your current investments, your existing investments? That says a lot about you too, right? If I ask about your existing investments, you give me a bunch of blue chip stocks, for example, that seems to be your thing, right? I might, again, a lot of this is done perhaps through an interview. I might say, what have been some of your most successful investments? What have been some of your worst investments? And, this might help me determine, your risk tolerance. One of the things we have when investing, is risk tolerance. What is your risk tolerance? Some people can do that. Some people aren't comfortable with that. I'll say, listen, the investments we're going to be making for you do have a certain level of volatility. And, what level of volatility are you comfortable with? Because, we don't really care about the price of the securities today, the investments today. We care about, based on that time horizon, what those are going to be. But, based on that risk tolerance will also, inform what kind of things I may buy or not buy for you. So risk tolerance, that would be based, on age. It could be based on income. Maybe they say, Dean, I have a very high risk tolerance right now because I have a long time horizon and I'm making a lot of money. So, or Dean, I had one client once say, Dean, I'm already rich. Just don't make me poor. I don't want a lot of volatility. This could be tied into safety of principle, perhaps, right? And then, there's a lot of things that don't show up as numbers. Risk tolerance isn't a number. And again, what they love to do on the test is say accept. So non-financial considerations are things that don't show up as a number. And so then you might throw this in that mix about, what is all the following are in the statement of cash flow, except, and these things don't show up as a numerical value. So what are your values when investing? Very popular right now. It used to just be called socially responsible investments, but now it's called ESG. That's not yet a test term, but I think it's would be. And I say, hey, are there any things based on your values? E.g., for example, it means for example in Latin. Is there something that you are opposed to? I remember when I was a practitioner, I thought some mortgage bonds were a pretty good idea, but the mortgage was on a casino and they said they're not going to do that. So maybe they want to be what it used to be called socially responsible investments. And now we have a whole category of investments called ESG. And that stands for, people who want their investments to be environmentally friendly or environmentally positive, or even in that sector, so to speak. S is for, so they want their investments to be socially responsible. in terms of the companies they're investing in or whatever the category asset allocation is. And then G has good corporate governance. And so again, this would be something to talk to the client about is, is there anything anything that I'm not allowed to do with your money or would make you uncomfortable? Your attitudes, what are your attitudes toward money? Again, non-financial consideration. That's something to find out. Some people just money. I mean, gee whiz, I had a guy was thinking about making an exception. Yeah, when I was a practitioner, my minimum relationship was $500,000, and I was thinking about making an exception for him. And I said, "What are you? How are you going to feel if you lose this money?" And he said, "I'd kill myself." I said, "Oh my goodness! Well, that ends this. I'm not going to be managing money, for somebody like that." So, what is your attitude towards investments and money? Yeah, I wish this guy would have had a bigger friend. There was a guy who thought he was upside down. It was a mistake in his account at this firm, and it was showing he was upside down like $700,000. He committed suicide. I said, "Man, I wish somebody would have told him, listen, that's not good." What is your investment experience? What is your investment experience? That's going to be informative too, right? Are you new? Are you just starting out? If you don't have a lot of investment experience, perhaps we, take baby steps with your investments. Get you something you understand. Maybe it's a mutual fund or a stock that you have. So, lack of investment experience. And maybe you have too much experience, but lack of investment experience means we want to be a little more careful in that. Demographics would be important. These are just the EG, right? The things that go into this thing are non-financial considerations. Demographics means, like where do you live and what's the cost structure there, perhaps. Oh, I said cost structure, bad move on Dean's part. Cost means number, so it's not that. What are some life events that are non-financial considerations? Getting married, not getting married. I mean, these could be, I probably going to miss some of these judgment questions on this, right? In terms of things that are not a number. Behavioral finance informs some of these things where perhaps we can help our client by avoiding common mistakes according to behavior finance. Like one of them is anchoring, for example. Anchoring is when given new information, you won't change your present course. This is really a problem with people who inherit positions or, they've worked at a company and their parents worked at the company, their grandparents before them, 3 generations have worked at the company. And so I'm trying to get them to diversify, and they won't diversify because, why would they? Because this block of stock, lack of diversification has worked for this family for many generations. Why would it not work now? And they feel like if we, diversify, it would be diversification. And so they won't do it, and then there's some problem there. So, anchoring is your failure. And I just gave you one example of that, but it's failure to make failure to change course and direction given a different fact set. I see a lot of this right now. In terms of hubris or, overconfidence. This is people who, they don't have any investment experience except the last 12 months. They tripled their money and now they're going to be, day traders for a living. So hubris or overconfidence is something that we can try and help. Listen, ladies and gentlemen, I know you're going out there into practice and I'm no longer a practitioner. And I would find that this present environment very challenging. Because I think there's a lot of people that think they don't need any help. So, maybe I don't know how we would, in terms of sales training, that's after you pass your test, maybe how we handle people who are suffering from hubris or overconfidence. Usually that gets solved by the market. Mr. Market will take care of that at some point. And maybe the solution is we just wait around until Mr. Market extracts that learning experience from them. Herd behavior, this is a big one. You know, all my friends are in the stock market. They're making money, man. I got to invest. I got to invest. I got to invest. Oh man, everybody's making money except me. I invest. Oh man, then it goes down. Oh, I knew I should have invested. Knew I should have invested. Oh my goodness. I gotta get out. You know, and they end up doing the opposite of what they should be doing. You know, they end up, doing the opposite. They're buying high and selling low. You do that 2-3 times based on the herd, the crowd. It's going to be hard to make that back up. So herd behavior or following the crowd, so to speak. And it's easier to follow the crowd now, particularly with this social media, right? And so we can help them perhaps saying, hey, listen, you shouldn't do this just because everybody else is doing this. You know, I feel good during the pandemic. I was able to help a friend of mine. She had a position and she was thinking about selling. And I said, well, what is the facts behind why you're going to sell that? And it wasn't any legitimate thing like diversification or, some legitimate thing. It was just, she thought everybody else was selling. I said, well, that's not a good reason. Why don't we wait and get the quarterly report and see what's going on? And, if we're going to sell, well, let's make it a conscious decision based on, again, information or facts, not just because that's what's happening right now with the crowd. Mr. Buffett said, you want to buy into fear and you want to sell into greed. You want to get on the right side of that. Client data gathering, we do have to identify our clients. And so in every firm, we're going to have written supervisory procedures. Those are called WSPs. And every new hire has to read the WSPs. And what this amounts to is we're going to want a picture ID. Something that proves you are who you claim to be. A birth certificate wouldn't work, right? Because it doesn't have your picture on there. And then within the supervisory procedures, the firm would have to have procedures for closing accounts where we're unable to identify. All right. By the way, this says 66 test specification, but it's the exact same document. And I'm going to be putting in the 65 and calling it the 65. The only distinction in the test specifications published by NASA for both 65 and 66 is 65. When you're following along this document, you will see it is the exact same document in this area. But I'm trying to avoid doing too much 65/66 stuff. So the only distinction in this whole category that I've been explicating is exactly alike, except 66s, you're going to get 6 questions in this category, and 65s, you're going to get 7 questions in this category. That is the only distinction. So that's why I feel okay putting one in one playlist and the other one labeling 165, 166. I haven't done that, just so you know. Use 66s. There's nothing in this playlist, in this explication, found in the 65 playlist that isn't for you. And 65s, there's nothing in your playlist. There's a lot of stuff in your 65 explication not found on 66 because it's not in the 66 document. So when the documents are common, I'm doing that. You'll see that the capital market theory, I think, is the same. When it's different, then I explicate it differently. So just so your own information. Again, you could always, if you got questions, comments, whatever, you can put them in there and I'll explain that in a better way. Now, a lot of firms do this several different ways. When I was practicing, saying, listen, for me to do a really good job for you over time, I need to ask you a lot of questions. It's possible, maybe we should schedule an interview. So some firms have official questionnaires, where they say you will do the interview and here's the questions you're going to ask and get responses to. In my, when I was practicing, it was my own questionnaire. It was my own document that I used to inform me in terms of suitability. But, we're saying these are practical ways to get done what we're talking about. So you could have an official questionnaire. Some firms require interviews where you're required to go out to do a data gathering interview. So whatever, the process is for doing what we've just been talking about. And then we talked about time horizon. We said that's a very important component of this thing is how long do you have to get to your destination in terms of that client profile? This whole, idea here has been about your client profile, client customer profile. As we said at the beginning of the discussion, the financial goals will have a time horizon built into them, whether it's retirement or college education or buying a house, whatever the case may be. All right. Well, listen, we don't schedule explications based on your test date. I've already had people saying, Dean, I see a lot of movement in the 65, 66 playlist, and it looks like you've picked up the baton in terms of finishing off those 65, 66 explications. And the answer is yes, but we can't time things based on your test date. But I do listen, I do respond, and I'm trying to get as much of this as up there as I possibly can. And as I said, I'm chunking it by just going along. So, here we go here. So next you can see will be capital asset pricing model, and the Sharpe ratio will be on our next installment. All right. So like, share, subscribe to the channel, and I'll see you on the next installment.